Chapter 2 is about economics. We're going to briefly touch on the topic, but we could really go into detail with economics. You actually will have a class on macroeconomics and a class on microeconomics. If you're majoring in business or accounting or something like that, you will probably take both of these. And both of these play an integral role in the global economy. What is economy? It is the financial and social system of how resources flow through society, from production all the way to consumption. And then we have economics. And the best definition of economics that I've seen is the science of choice. In economics, we're concerned with the decisions that people and organizations make within an industry, state, country, or other group. We need to understand why people make the decisions they do in terms of what products to make, how to sell those products, and why people buy them. And then we also need to know how people and government influence society. So in economics, we study the past to help establish a framework for our future decisions. Many people think of economists as looking into a crystal ball, but really there are frameworks that are used to make accurate predictions. So macroeconomics focuses on the big picture. In macro, we're concerned with studying the overall economy. For example, the U.S. economy. In this, we're going to look at inflation, employment rates, the flow of money, recessions, productivity, and other key issues. Micro focuses on smaller units such as individual consumers, families, and individual businesses. Each day we make choices, and we make choices of what we buy. Think about that the next time that you're buying something. For example, if you were to go and buy a Coke or any kind of drink, soda, and let's say the price went up to $5. Would you buy it? Well, it's going to depend on how bad you want that product. It's going to depend on your income. It's going to depend on the prices of other products, other competition. So that is kind of what we're looking at when we're talking about economics. In the latest half of the 1990s, the United States enjoyed unprecedented growth. The unemployment rate was low, productivity was high, inflation was low. The real standard of living for the average American rose significantly. The economy grew more than $2.4 trillion, which is a jump of 33% in just 5 years. But if you remember, the dot-com bubble burst in 2000, and I'm just thinking about this as I'm saying this. You probably don't remember because some of you weren't born yet. But just to tell you my age, I graduated in 2000 from high school. So I remember when this happened. I remember in 2001, the 9/11 terrorist attacks. When that happened, I was actually at Holmes Community College in a science lab when I found out about the 9/11 attacks. So this is around my time, and I remember this. The stock market dropped, the unemployment rate increased, and the economy was on the brink of recession, which is kind of what we're looking at now. So what happened was what we call subprime mortgage loans. And these were granted to people with low credit scores. and it provided lenders higher return than many other investments. But what happened is the housing prices peaked in 2006. So they were on their way up, and then they peaked and they started going down. And the peoples that borrowed the money from the bank, they owed more to the bank than the actual value of their home, and this led to the collapse of financial institutions. And since that, if you have tried to buy a home or apply for a loan, it's a lot different now. There's a lot more regulations, and that is because of this happening. So in the late 2011, the economy started picking back up. Employment grew slowly for 49 months in a row, and that was the best run since at least World War II. And the Troubled Assets Relief Program was developed and introduced an economic bailout plan. The government passed the American Recovery and Reinvestment Act to help the nation recover from the financial disaster, and it included cutting taxes, building infrastructure, and investing in green energy. The government plays a role in managing economic conditions. They influence the budget decisions and the amount of money in the company. Government can make changes, and these changes will affect economic growth and economy. They'll make these changes to contain inflation and to monitor growth. But the ideal, and you can write this down, is sustained growth. We don't want rapid rates of growth or contraction. First, we need to talk about what fiscal policy is right here. And fiscal policy is the government's effort to influence the economy through taxes and spending. So the key here is finding the right balance. If we tax too much, then that can be beneficial, but think about it. When things are taxed, those taxes have to go to the right things, or they have to be spent properly. But if we tax too much, if the government taxes too much, I guess I shouldn't say we, but if we are taxed too much, then what happens? We pay those taxes, and then we have no money left to spend, and that will affect the economy. But then if taxes are too low and we have too much money to spend, which I don't think there's such thing in my household, if we have too much money, then people are going to be spending so much so fast, and that can cause issues too. So we have to find the right balance, or the right balance has to be found for this to work. Every year, the government has to create a budget, a financial plan that outlines expected revenue from taxes and fees. You probably have your own personal budget. Well, this works the same way. The government makes this budget, and we can have a budget surplus, budget deficit, and a surplus is when the revenue is higher than the expenses over a given period of time. So we have a little more left over. And then the budget deficit is when expenses are higher than revenue over a given period of time. So thinking about this as a personal budget, when you have more bills that you owe than income you make, you would have a budget deficit. But if you have more income coming in and it covers all your bills and you have some left over, that would be a budget surplus. Federal debt is the sum of all the money that the federal government has borrowed over the years and not yet repaid. So if you have a chance, you can go to the U.S. debt clock and you can look at a real time of debt. and you can see all the different types of debt. It's kind of depressing to see, but also it's eye-opening to see this in real time. So if you get a chance, go to this website and just look at all of these numbers, especially if you're a numbers person. Here you can see the federal government revenue for 2020 and the federal government expenses for 2020. So you can see that and this is in billions of dollars, you can see the revenues are less than the expenses. So we have a budget deficit. And these numbers changed dramatically after COVID. And by the end of 2020, the U.S. federal debt stood at $26.95 trillion. And this is important to taxpayers because the government repays the debt, and not to mention paying the skyrocketing interest to finance this debt. Less and less money is going to be available for other uses. Services may be eliminated or taxes will soar, in which we don't really want to see taxes soar. So all of this impacts you whether you think it does or not. Now we're going to look at monetary policy. So remember, fiscal policy, the government makes these types of decisions. And then now we're looking at monetary policy, which is the Federal Reserve. And this is the decisions that shape the economy by the interest rates and how much money supply there is. So the Federal Reserve is a 7-member board, and they oversee the operation of the 12 Federal Reserve banks that carry out Fed policies and perform banking services for your banks, for the commercial banks in their districts. So commercial banks, what are those? Those are privately owned financial institutions that accept demand deposits and make loans and provide other services for the public. So when you think of a bank, you think of the commercial banks, but we also have the Federal Reserve banks. And you can read the functions of the Federal Reserve here. Then we have some terms about money. Anything accepted as a medium of exchange, a measure of value, or a means of payment. So the total amount of money within the overall economy is called the money supply. We have the M1 money supply, which is all currency plus checking accounts and traveler's checks. And so you think of money, this is really what most students think of money, but you also have the M2 money supply. And this is all the M1 money supply plus the savings accounts, money market accounts, and certificates of deposit. So those are your two categories there, M1 money supply and M2 money supply. The Fed's most frequently used tool is the open market operations, and this is where the Federal Reserve buys and sells Treasury bonds, notes, and bills. Discount rate changes. So this is the rate of interest that the Federal Reserve charges when it loans funds to banks. This impacts you as far as what interest rates you get, because these are the ones handing it. The Federal Reserve hands this down to the banks, and they in turn loan you the money. And then reserve requirement. This is a rule set by the Feds which specifies the minimum amount of funds a bank must hold. So they really tell the banks what to do. And it's expressed as a percentage of the bank's deposits. In the next video, we're going to talk about capitalism.